rates are not done rising, not by a long shot. This election cycle is going to be different for a couple of reasons. And number one, I think it'll be different and problematic if it's Biden versus Trump, but it's going to be monumental is the impact of AI. The easy play is take 50% of what you have. And I know that's a lot for a lot of people, but I would put it in the triple Qs.
Hi everyone, Chris Johnson here with the Morning Buzz by Money Morning. I've got a special treat for you today, bringing in a friend, but also somebody that I respect very much in the market to give us a little bit of insight as we head into a new year of trading. He doesn't really need an introduction, but I'm going to give him one anyway. He dates back to 1982. That's right, 1982. In the mean streets of Chicago, where he first started trading with a hedge fund, also worked at the CBOE in what we referred to back then as the OEX option pit. That's the S&P 100 for all of you old option traders, which I traded those OEXs. You've seen him on CNBC. You've probably also seen him on Bloomberg and Fox Business News. Probably read a lot of quotes from him in the Wall Street Journals, Barron's, Washington Post, the New York Times as well. So his opinion is heavily sought after, and I'm really privileged to have him here today, talking the markets and looking forward to 2024. His name, Shah Gilani. He is now the chief investment strategist with Manward Press. Shah, as I said, I don't think you needed an intro, but I hope you like the one I gave you anyway. How are you doing today, my friend?
I'm doing great, CJ. Always wonderful to be in your company. Great to see you. We got to get together, play a little golf, and do something fun.
Absolutely.
Been too long, my friend. Too long.
Absolutely. Hey, let me give you a reveal here. The date, February 21st, 2000. Remember that? What was going on back then? All kinds of, a little bit of a ruckus in the market. This young guy, his name was Chris Johnson, actually gets to pen something for the striking price in Barron's. Got a little bit of a guess.
Wonderful.
Yeah, and guess what I was writing about? The VIX. The VIX, and talking about how there was no fear in the VIX. It just added up for me. I had to bring this up because we've had a connection. We've had a professional connection for the last 6 or 7 years. But if you go back to 2000, my gosh, we've got an even deeper little bit of connection here with the VIX. We'll get to that in a second, but I just wanted to share that. I think that's really cool, man.
That's good. That's cool. Long back. So further than I thought. Thank goodness.
Yeah, absolutely.
I always thought I knew you. Now I know I really know you.
That's exactly. We're numbers nerds down at the heart of everything. Hey, let me set something up here. All right. I'm going to set the stage. Last 2 months, November and December, we roll into 2024, the end of 2023, and this market is just off the hook. It feels like everybody's jumping in. We saw a 14% move in the S&P 500 to the upside. That's the third best year, and it's not by much in the last 30. So this market has really taken off. You got that feeling that, and you've been quoted a month or so ago as talking about the wall of worry, which is one of my favorite phrases when it comes to the market. It is true. But when we got right to the end of the year, we crossed the finish line. We started to see investors kind of get a little bit greedy, whether it's the VIX coming down, whether it's the CNN Fear and Greed Index, all of these things, investor polls like Investors Intelligence. What happened there? Was that just everybody trying to rush in? We hear about Santa Claus rallies, but they don't really come at that magnitude. What do you think pushed that market up for the last couple of months?
I think historically we're going to scratch our heads and forget, in spite of how great a year 2023 ended up, whether you're talking about the S&P 24+%, the NASDAQ composite 44 or thereabouts, and the NASDAQ 100, I think we're north of, or just a shade north of 54% in 2023. People are going to forget how volatile 2023 was for the bond market especially, but also for equities until, of course, November. October was an ugly month. And all of a sudden, November comes, and you turn the page in November, and I think money managers started to look for bargains and thinking maybe towards the end of the year. And then, of course, that was supported by the change in narrative from higher for longer vis-a-vis the Fed to they're going to have to cut. And without really seeing any sign of recession, the narrative took hold that the Fed was going to cut in 2024. That surprised a lot of people. It certainly surprised me. But you turn the page on November, and all of a sudden there was bargain hunting going on.
Mm-hmm.
That surprised a lot of people. It was initially again in the Magnificent Seven. Of course, tech has been leading and for probably a decade and a half at least. And once again, the Magnificent Seven led the way higher. But then we started to see a little broadening out. And then we saw more of it in December that turned into what I'm calling in November to remember, turned into a Santa Claus rally. We had a wonderful December. We ended on a high note and it looked all great. So that's the obvious lead up to what happened. In hindsight, now, at the time, I didn't see it this way. I just thought this does make sense because things did look cheap. And if the narrative has changed, so be it. The trend is your friend. Time to pile into a lot of this stuff. But looking back now, it looks to me like a short covering rally and a FOMO rally. And maybe we see through the first few days of the new year that the bloom is off the rose. For how long, I'm not sure, but we may see some hiccups. January may be a little tougher than we thought. I'm hopeful it will end higher at the end of January, and we'll have a January to remember. And, as the old adage goes, Wall Street adage goes, as January goes, so goes the market. We certainly saw that, Chris, in 2023. We had a great January, got dicey all over the place, started to rally, and then got dicey again in October. At the end of the year, if you look back to January, it's all you had to do was go by that old adage. It was a great year. So I think looking back, there was a lot of short covering, especially in the bond market and in the stock market, and then fear of missing out, both in bonds and in equities, as investors thought, and that's how we got the broadening out. And here we are. So that makes sense looking backwards. At the time, it was very hard to see that's what it looked like. But now the question is, I think we're going to come to the age-old question of what will earnings be? And will the rally be justified by fourth quarter earnings? And moreover, what guidance will be for Q1?
Yeah. You mentioned something, and that is hope. Whether it's investors hoping, whether it's analysts hoping, it feels like, and just to go along with that wall of worry, stocks climbing the wall of worry, I've always said that they slide down a slope of hope. So you get a little bit alarmed when everybody's jumping in. Let's stick with the Fed for a second, though, because that narrative, as you pointed out, has changed. We've gone from that higher to longer to now. The market was trying to wag the tail when it came to the Fed last year. The bond market kept trying to top out in terms of the yields on the 10-year and really kind of said, hey, the Fed's got to stop at some point. Now the Fed has kind of tipped their hand, or they blinked a little bit. How much of the last 2 months is just that, not even FOMO, but everybody's saying, aha, we knew this was going to happen, and they want to get in? Because when you look at it, you mentioned the Magnificent Seven. We spread out from that a little bit. You started to see the regional banks. You started to see small caps, a little bit of those areas that have green shoots that you want to see. They started to bloom. What do you think about? Is it true that the market is going to be driven by the Fed in 2024, or are we going to see the Fed kind of be laid by the wayside in terms of a catalyst?
I think the market will be driven by the Fed. It'll also drive itself in terms of maybe drive over the Fed. I'm not so sure that I would guess, if I had to, that the Fed is done. I'm not 100% convinced that there wouldn't be another hike if we see some rise of inflation. There's still the credibility issue the Fed faces. The market has gotten, financial conditions have gotten as soft as they've gotten. That's obviously going against what the Fed wants to do. And if things turn around as far as inflation, so far the trend is great. It's downward and it's marvelous, and that's something we all want to see. But I don't think we've seen the end of inflation. And if we do see some spike, probably at this point, perhaps looking unlikely that it will be driven by an oil spike. But that's always out there. We know the oil as a commodity is one of the most volatile commodities, and anything can happen. If we see WTI over 100, 105, 110 again, I think that'll change the dynamic. And so I'm not saying that the Fed is 100% done, but I'm 99% in the camp that they're done. And as far as cuts, I'm on record saying I don't think we're going to see a cut in the first quarter. I think second is probably unlikely. If we see it, we're going to see it in the second half some point. So what I mean by the market running over the Fed is this is going to be market driven now. It's no longer really Fed driven. The
Right.
market is going to determine where rates go. If the rates get up to 425 on the 10-year, wouldn't surprise me. Get to 450 wouldn't surprise me. I think a lot of bond bettors would be surprised and getting beaten up. Then that's how difficult of a year it was in 2023. I think bond investors are going to have an equally difficult year in 2024 because the market, the bond vigilantes are going to be out there. And if they see signs of inflation, they're going to be out there. Last thing I'll say about that, Chris, and then maybe we'll get into a little bit later. I don't think that there's sufficient focus on the interest cost of the debt and the cost of entitlements. By the early 2030s, half of all the money spent by government is going to be on entitlements and on interest expense. That's going to create some crowding out. And interest rates are going to rise. Whether they rise in 2024, I'm not so sure. I'm betting we're going to have an up and down 2024 as far as bonds, but rates are not done rising, not by a long shot.
Wow. Wow. All right. Let me go. I got to ask this then. We saw Goldman Sachs, a number of the other big Wall Street firms in third quarter or so start to bring back the expectation that we're going to see a recession. 7 times the yield curve's inverted here. Let's call it in modern history, right? Each one of those times preceded a recession. This time, it feels different, and everybody's all of a sudden backing off of that. You've mentioned, the debt that's kind of piling up, and that's crippling at some point. Yeah, I do want to touch on that in a few minutes here. But what about a recession? Are we going to duck this? Is this going to be the time when the yield curve was wrong?
I think for the viewing audience, I've got to preface that by saying I always take the position of the trend is my friend. I don't like to
Right.
try and predict where the market's going to go. I try and predict it if I'm going to do that based on where the trend is. And if I see the trend change, I change. But right now, the trend to me looks bumpy in terms of the bond market and looks positive in terms of equities. Until that changes, I'm buying the dips in equities and I'm going to trade the bond market up and down. So I think we're going to see that kind of volatility all year. As far as longer term, there's no way we can escape the cost of the debt, and I don't think we're done with inflation either, because the things that created the I would call it the almost deflationary period that we had was the bringing China into the World Trade Organization in 1999 2000, and all of a sudden we had tremendous flow of Chinese exports from China into the U.S. Really, they were exporting deflationary effects here, which we were probably globally the primary beneficiary of, and that worked beautifully. That's over now. China still needs to export, still wants to export, but now we're in the beginning stages of a U.S.-Chinese digital Cold War. And part of that has to do with the chips. That's front and center now, but it really started under the Trump administration with the tariffs on China and the reshoring that we're wanting to see and needing to see and have started to see. The Chinese are going to be pushing back on that. And so we're going to see supply chains move around, and a lot of the supply chain issues people are fearful of being held up in China, they're going to reshore. A lot of the U.S., people forget the U.S.'s biggest trading partner isn't China anymore. It's Mexico. And
You know what?
second is now Vietnam. Who's investing in Mexican manufacturing and in Vietnamese manufacturing? The Chinese.
Yeah.
So they see the handwriting on the wall, obviously, and that means inflation is we're not going to have exported deflation from China anymore, and commodities are going to go up, materials are going to go up, and I think we're going to see spikes of inflation for some time to come. But the general level of prices is not going to come down. we're up here. We're 20, 25%, depending on which goods and services you're looking at, above the 2019 baseline, if that's what you want to use for a baseline in terms of inflation. And we even know we got CPI coming up, and if we see something less than a four handle on CPI, that's still growth. That's still an increase in CPI of 3.8 or 4%. We're not going down. We're continuing to add to the higher price level. And that's going to work its way through the economy. And again, that's going to impact borrowing. It's going to impact the banks. It's going to impact inflation. It's going to impact bonds.
Yeah. This is kind of playing out of the robbing Peter to pay Paul in terms of inflation for so many years, down at that 2% and even less than 2%, at the same time that we were growing like crazy from GDP's perspective, right? That's what I think I hear you saying. This is just something that time had in store for us.
More geopolitics than anything else, I think.
Okay.
I mean, this was look the weight of the power curves shifted to China versus the U.S. and they pretty much held court, and that's all good for them until the Trump administration came along and said, well, it's not so good for us anymore. We've lost too many jobs, and the supply chain stuff. And this is before COVID is a problem, and he saw that. So, to credit to the Trump administration. And so this was in the works, but it served everyone's purpose. So the tariffs, as onerous as they were in some areas, were light across the board. But it was a message. The Biden administration has kept that messaging going, and now we're with the chip wars. We're in full-fledged Cold War territory again.
You back away, and we've heard about superpowers and Ray Dalio. Everybody knows Ray Dalio is the famous hedge fund manager. But he also wrote a book a few years ago that talks about superpowers and how they change hands, not just over the last 50 years, 100 years. We're talking hundreds of years here. And it comes down to that idea, and I think you've just hit on it, that you export something or somebody takes something, in this case, manufacturing and the IP that goes with manufacturing, to get an easy take or a couple of, again, robbing Peter to pay Paul. Do you see that playing out? Is that what I hear you saying when you say not only a digital Cold War, but it feels like it's that superpower shifting now to where the United States is going to be less dominant? And that would be, when I look around, all the central banks in the world are buying gold right now, right? That's kind of one of those things that starts to point at the US dollar and what's going to happen over the next 5 years or 10 years. How does that play out? I mean, is that really playing out with your Cold War situation, the digital Cold War?
I think it's going to play out. The manifestation will be volatility in the markets. Yes, it's happening now, and it's going to become, I think, rockier. We see the expansion of the BRICS has already started. It's no longer just Brazil, India, China, South Africa, where there's several other countries that are joining the BRICS. They're already talking about a digital cryptocurrency. Not sure whether it'll be backed by gold, but and Saudi Arabia's been talking about that. So there's been several geopolitical spheres that have been talking about enough with the dollar being the world's singular reserve currency, because what happened with Russia when they invaded Ukraine, and we saw what happened with the systems that the U.S. shut down. Everybody in the world said, well, that's the system through which I bank and through which payment transmission occurs globally from bank to bank, and you can be shut out of that. And that was a wake-up call for everyone. And that's when we started to see a real push into diversifying from the dollar. Now, it's not going to happen overnight. It may take quite a few years. The dollar will remain, I think, probably for another decade or two, certainly a very important reserve currency. Maybe for another, I would say, 5 to 10 years, the singular reserve currency. But there's encroachment there. And that's just part of the geopolitical tension that's starting to happen. We're seeing China, exerting its influence in Africa as it has been for a couple of decades now, and we have issues there. In Pacific Southwest, we have issues there. China is exerting its influence wherever it can. As the U.S. pushes back on China, China's pushing on its neighbors to get closer with China. And they're doing a lot of things that the U.S. isn't willing to do. So it's we're in for, I think, a bit of tumult, and I think it's going to be geopolitically a really rough and tumble year. The next couple of years, a few at least, and markets are you're gonna have to figure out which side to be on because things are going to move.
Okay. We're talking geopolitics here. Let's bring it back to home. 2024, we're half of a month in, right? 2-3 weeks in right now. Everybody is looking at the market, for 2024, and right now they're hoping for a repeat of 2023. We've got a big thing that's happening, obviously, in 2024, and that comes in the form of an election. Typically, you see an election, especially when you've got an incumbent that's running, that favors the market right now. And you are talking about that volatility kind of taking hold, and it sounds like just churning the market. Two questions, and I'll start with the first. Do you see 2024 playing out as a traditional election year in terms of the seasonality, which is bullish? Or do you see something different with not only geopolitical concerns out there, but perhaps domestic concerns?
I would say, and I don't know how many people, probably everyone has been has regretted saying this. I think this time is different.
Mm,
This election cycle is going to be different for a couple of reasons. And number one, I think it'll be different and problematic if the if it's Biden versus Trump. If Trump, obviously the clear front runner for the Republicans is Trump. I don't know that anyone is going to supersede that. I don't know what's going to happen with eligibility in certain states on
right.
the ballot. There's a lot of stuff going on there. What I can tell you is that the die-hard Trump fans out there and backers are going to use all of that. And if he is the nominee, all that stuff is going to come out. Everyone's taking all of this and putting it in their back pocket. It's going to be ammunition against the Democrats. And I think this, and if it's Trump versus Biden, it's going to be, I think, exceptionally ugly. And throw into that mix, it's not the first time, but it's going to be monumental, is the impact of AI. Now, we saw even in the last election, we've seen in a couple elections, Russian interference. We know it's out there. There are other state actors who employ AI, whether they're bots and trying to change um, counting, whether they're trying to change surveys, whatever they're doing. Yeah, they're polls, on and on and on. The ability now, we just think of what we're able to do with Chat GPT and what really smart people who are applying it every single day, trying to figure out how to use Chat GPT. Well, how about all the other players who have smarter stuff than Chat GPT? They are the state actors, and they're going to be using it. And the Democrats are going to be using it. Republicans are going to be using it. All of their constituents are going to be using it. I don't think we're going to know where the messaging is coming from, whether it's real. This election cycle is going to be, first of all, I think, a bit frightening. And second of all, it's going to be a head scratcher in terms of what do we trust? Who do we trust? What sources do we trust? Now, there is no transparency. There's no legacy where you can look through any AI and see what the origin story is. Who coded it, or was there any bias in that, or how? What's the purpose of it? We don't know. We're not going to know. And we go into the election, we're going to see more and more of it. It would not surprise me. I'm going to go on record. It's not a nice thing to say, but I just want to be on record because it does worry me. It would not surprise me if we saw some civil unrest this year because of the election.
Yeah, it feels like we're right at that. I used the term, I think, yesterday. We're a tinderbox right now. I mean, we're waiting for something, a spark to drop, something. And when you have geopolitical concerns, when you have, as you said, bad actors, frankly, Shaw, I didn't think about AI being a big play in this. You think of it a little bit, but I really, as you said, almost weaponizing AI with those bad actors, that leads to a bad situation. I mean, that leads to uncertainty that I don't think the market, or as you kind of said, our democracy can kind of digest and handle right now. I mean, we've had, and we're two, we're about in the same neighborhood on age. Maybe, I don't know, maybe I'm an exit
Seasoned.
or two.
We're seasoned. We're seasoned traders and investors.
Okay, that's the word I was looking for. But we've
Well, I
been through,
am. You're not. You are quite a bit my junior, young man.
well, I didn't want to say that, but we've both been through
You just did.
two. Yeah, we've been through two contested style elections, right? When you look at what happened years ago with Bush and Gore, and then just this last election cycle, that is turning into more of a trend than it is the outlier. It feels like, and as you said, I think that's a curveball that the market can't maybe not be able to handle. That leads me into my second question. If we think there's going to be volatility, everybody's bullish right now. Is there a way that the person at home just kind of gets to the finish line of 2024 with the least harm in terms of their portfolio? Is it value investing? Is it sitting in cash? What's the general playbook right now?
Well, first of all, I don't think it makes sense to make long term commitments. Because we don't know. There's too much volatility out there. There's too much that can turn upside down. So it would be difficult to make a long-term commitment, stick with it, and perhaps not get beaten up or just be wishful hopeful that you pick the right small portfolio, let's say, of stocks and they all go up. If I'm not a big diversifier, I think 15 stocks is probably too many, but 10 stocks, 12 stocks is probably the right number for me. It usually gears more towards 10. Um, and the 10 that I choose, that I rotate them, the ones that are working, that let me just back up a second. Every position I go into, and I'm sitting on a lot of cash right now, every position I go into is not an investment, it's a trade. It's a trade, even though I want it to be an investment. I want to hold it forever. I want it to continue to go up like an Apple or a Microsoft, let's say, for decades. It's not, it's a trade. And in this environment, I think people have to go into every position with their trading caps on and not think of this as whatever position they're putting on as a long-term investment, because you're going to get hung up and hanging on to that position if it goes against you when it should be a trade. And I think that the way to play 2024 is going to be with your trading cap on. If you're right, and the trend is our friend, and right now the trend is higher, if we continue all year, let's say, or we get through some bumps and maybe you get stopped out with profits and you buy the dips, that's what I'm doing now. I'm buying dips. If I'm putting stops in, I get stopped out. I ring the register. I'm not worried about taxes. And the next thing I know, I'm looking for dips. I've been since July. I've been looking to buy dips, but they're trades. If they continue to run, great. I'll even add to them on the dips, and I think those are good positions. So some of them I don't have stops. I'm like, oh, it's not. It comes down where I'm a little wish that it stayed a little higher, but down here because I'm buying dips, I'll add to some core positions. That's not to say I don't have stops on pretty much everything, and I'm talking mostly mental stops. I tend to not put stops down unless I'm
Right.
traveling. I'm going to be out of pocket for some time because I want to say I like the leeway of like, oh, this sell off is a narrative sell off based on X, Y, or Z happening. This is going to pass in a couple of days, and then I don't want to be stopped out because by the time you reapply a position, it's going to be another 5% up, and you're just missed out. So, but I think 2024 is going to be about um, it's going to be a trader's market first and foremost. If you're smart and you have the right positions and they extend and they turn into investments over the next couple of years, all the better. But I think it's going to be about nimbleness, and that's the way I'm playing it. I got asked this question the other day, and I had a pretty, I think, packed answer, and it's an answer I'm going to pretty much use for all of 2024 for folks that aren't active, that just like, I just don't want to be doing too much. What do? The easy play is take 50% of what you have. And I know that's a lot for a lot of people, but I would put it in the triple Qs.
Yeah. The
If you
NASDAQ
want to
100.
index, if you want to index to the best moving benchmark, which is the NASDAQ 100, which is represented by the triple Q ETF. So Yes, that's what I would recommend. The rest of it, you trade and you put on the positions in Microsoft. Maybe you buy Apple on the dip. Maybe you buy good core companies in NVIDIA on a dip if it never dips. And you looking for positions that make sense given the narrative of the future being AI. The future is always going to be technology. You see maybe commodities dip. I think commodities are going to be great in 2024. Materials are going to be great, but I look to buy those on dips. And again, I'm going to ride them up because materials, they trade like commodities. Commodities are commodities. It's not a buy and hold ever in a commodity. If anyone thinks that, think again. You trade commodities. You don't long-term hold commodities, but you can make a lot of money on the ups and downs. And I think that's the way to play 2024. You've got to be nimble, but if you want to be comfortable with an index or benchmark yourself, don't do it at S&P. I would do it to the Qs.
Yeah. Yeah, I agree. I mean, we hear about the Magnificent Seven and, how well they've done, and they'll continue to do well. Obviously, we watch a number of those just because of AI, but, that has been the leadership and it's become the popular. That's where curiously, in 2022, that kind of turned into the safety trade. Everybody thinks about bonds being the safety trade and, all of these things, but my God, the NASDAQ 100 actually turned into the safety trade because everybody wanted to be in large cap tech. It is Amazon, and I'm asking you this: Google, Amazon, Apple, are they the new Procter and Gambles of the world?
I'm not. I tell you, I'm a little unsure about Apple in here. I'm a little down on Apple. I'm out of Apple at 181, and I'm looking to buy a dip. I was on Mining Company the other day, and I said it could go down to 120. I think
Yeah,
that shocked a lot of folks. But I think 145 is a buy. First of all, it's got to get to 160. If it gets to 160, folks, that's something to scratch your head about. If it gets to 160, you can get to 145. Now, this is what I'm talking about in terms of volatility. I think Tesla's going to have problems too. And if you have Tesla and Apple having problems and unable to find, say, an area to consolidate, then we're going to see pressure on the market. Those are the dips I'm going to look for. I'm going to say, okay, I thought I might see this happening, so I'll be out of my stuff. We stopped out, and I'll be like, let's just see how low we go here. But at the end of the day, if you get companies like Microsoft and NVIDIA, um, other great companies that you want to own, come down, then you wait, and it doesn't. You don't have to buy the bottom when you start to see things turn around. I don't care if you miss the first 10%, who cares? Because you're likely going to go up another 10, 15, 20. And if you're right and we end up with a 2024 looking like 2023, you'll end up with 30, 40, 50% if you're in the NASDAQ Qs as your base. So I think that's the way to play 2024. But I'm not so sure about Apple and Tesla in here. I think again, I'll use the phrase I used earlier. I think the bloom is off the rose on both of them. Apple
yeah,
has Chinese problems. Apple is going to get caught up it's already caught up in the digital Cold War between U.S. and China. It's already, people don't realize it, it's already caught up. Um, and Tesla, it's the first mover advantage has been so terrific. It's been, but it's tired now. It's no longer. You look at BYD and what they're doing, and there's a lot of competition, a lot of good-looking electric vehicles out there. But at the same time, you've got the used electrical vehicle problems. They're piling up on used car lots. People don't want them. So
right.
we're not. This isn't all EV. We're not there yet. And so EV has still got to go through a little bit of a cleansing.
Yeah. And Tesla was in that enviable position of being the only game in town for the longest time. Now they finally have people barking at their heels, and it's showing. The stock is a little bit tired, and as you said, BYD right now is, call that part of the Chinese problem. They are really barking at their heels right now. Question: you've talked about the trend as your friend. One of the things that kind of turned around and started going trend friendly, and this is, call me eclectic, call me whatever, old school, Shaw, but the 60-40 portfolio. everybody looks at that and they said, and let's put it into another perspective here. When you said something about buying the dips, I remember Amazon at 85 and the market was screaming, oh, this is it. Amazon's going to go down to 60, or this is going to be. Amazon bottomed at 85. It was the old Warren Buffett thing. You buy when there's blood in the streets. Kind of the same thing happened with the bond market. We saw a lot of people selling bonds in 2023. You had Bill Ackman and a few other of the big gurus come out there and say, hey, this is it. It's over. But as you said, the bond market is kind of even vacillating itself. It's volatile. Are people getting suckered back in with the idea that they can go? My mom and my dad are still using a derivative of the 60/40. Are they getting suckered in by feeling it's safe with a bottom in bonds?
Well, if you got suckered in and you ended up buying some fixed income instruments with high yields, let's say close to the high of this past cycle,
Yeah.
and you're going to do 60/40 off of that, fine. And as long as you have duration, on what you bought. But no, I don't think 60/40 is back because, as I said earlier, I don't think we're done seeing rates rise. And I think, the pendulum has shifted and rates
Yeah.
are going to rise. We're going to have to live with higher for longer in terms of the market moving rates higher. And I think 60/40 will come back then. I don't know when that is, but I don't think, if your people are loading up now, I think that could be problematic. If you're loading up now as we're coming down, because why wouldn't you? Because, oh my gosh, I could have locked in. We're talking. Let's just use the 10-year Treasury. Oh, I could have locked in 5%. Oh goodness, I could have locked in 4%, and then we were down to 365. Well, no, you can lock in 4% today. So when 365 and people were running, buying hand over fist, thinking this is the end of the bond, the highs, we're going to come down. The Fed's going to cut. We're going to see the 10-year 2%. I better buy now, and then even I can get some appreciation. If I want to lock in some yield, my 60/40. Wrong. You're back at 4%. We're going to be back at 425 not too long from now. And so I think it's going to be very difficult to lock in. And for me, 4% is not a great. I'm not enamored with that. But for folks who are buying junk, buying high yield and junk,
Right.
they've done much better. I
Yeah.
mean, the spreads over Treasury, as far as high yield goes, they're touching on lows in this cycle, which says something about investors' belief that we're going to get through. There won't be a recession, and hence the high yield instruments will be fine, and rates won't spike, and high yield will be fine, and until they locked in a lot of high yields. Let's hope they're right. But I don't
Right.
think they are. I think we're going to see that again. So I don't think 60/40 is back yet. I think at some point it'll come back, but I would think you're better off 60/40. And this is going to sound a little nutty, but it's practical. You're better off with a 60/40 in almost 100% equities. Why? Because you can get your yield on your dividends,
Yeah.
right? So your fixed income vehicles don't have to be bonds. They can be fixed in terms of dividends, which can not necessarily aren't necessarily fixed. They can go up. Now,
Yeah.
you pick
Right.
crazy high flying dividends, they could get cut, but we're talking about solid yields and the aristocrats and solid companies where the yield is pretty steady. And then I think there's your fixed income. There's your 40 component right there, and you have appreciation potential if you pick the right stocks.
Right. So it sounds like it all comes down to, and you've already said this, it's a trading environment, whether you're in the bond market, the stock market. Right now, you just kind of have to be nimble and be quick to adjust with whatever's going to come, especially with all those uncertainties that we've already pointed out here, geopolitical, domestic, whatever it may be. All right. Last question for you. I know you like to play buy this, not that, right?
Sure do.
Can I give you a couple of ETFs here? They're going to go a little, we'll stick with the sector calls. That sound
Okay,
good? All right.
let's do it.
Healthcare's been on a rip here. Everybody hates healthcare. Everybody loves semiconductors. Which do you buy and which do you not buy?
Split. You buy them both.
You buy them
I
both?
think. I think you buy them both. I think you split your cap. If you're talking about a chunk of capital and you're like, I'm going to go either or, split your capital, split them between semis and healthcare. I think healthcare is going to do well. Long term is going to do well, and semis we know are going to do well.
I love that. I actually love that because I look at healthcare and every analyst in the world is beating up the healthcare sector, whether it be the biotechs, whether it be the providers. I mean, they're all getting put under the train right now. And going back to that example with Amazon, that's usually a great time to buy. So that's kind of a little bit of
And
growth in value in one swing right there with
you get
those.
and CJ, you get some good healthcare companies, some big pharma companies with some very fat dividend yields.
Yeah, absolutely. All right, industrials or home builders right now? Industrials or home builders?
Industrials. I
Industrials.
think yeah, I think we're going to. I think the industrials, they've been beaten up, and cyclically, I think they maybe have a little more to go on the downside, but they're going to be there's going to be a resurrection in the industrials, and I think they're going to do well. Home builders have done well. I think there's volatility ahead for the home builders. Great. America has some really fabulous quality home builders that are very profitable, but I think they've gotten ahead of themselves here. I'm not saying housing's in trouble. I'm just saying that if we're going to see continued high inflation or just steady state inflation,
Right.
uh, and rates remain relatively high, I think the home building market's going to be a little more difficult.
Yeah, it's funny because I visited Florida, where you are right now, just a couple months ago, and it's amazing how much inventory is being built right now in that sector. And you kind of look at it and say, "Oh my gosh, what's this going to do? Are there really this many people looking for houses?" And Florida's it's not the exception. That's happening here in Cincinnati, Ohio, as well.
And a lot of that, CJ, is the hangover from the pandemic, and people are still looking to move, and of course you still have the back part of the baby boomers retiring and looking where's my final resting place. And of
Hmm.
course you got the younger generations, you got millennials, you got they're looking for like, well, where do I want to live, where's my lifestyle going to be, and but that's starting to slow. I'm looking outside my condo here in Sarasota, Florida, and the cranes are up. There's a lot of building going on, but and prices have gone up exponentially,
Right. Yeah.
but they're starting to come down very slowly. I've seen it topping out.
Yeah. Yeah. I'm like a lot of those homeowners out there. I want to sell because the price is up there, but I've got to go buy something if I do. And it's a quandary. All right, one more out of two here. And this is a bet on the consumer or not the consumer. Consumer staples or consumer discretionaries. Man, everybody has been buying whatever they want for the last year, regardless of whether we were
Wow.
going to see a recession. I mean, they literally. So, 2024, do we spend money buying what we want, or do we spend money buying what we need in the staples? Companies like Procter and Gamble and Colgate that are boring. My parents' companies.
Oh my gosh, I'm going to say only because discretionary has fooled me and it's had a good ride. The Staples I thought would have done better. I'm going to go with the underdog. I'm going to go with Staples over discretionary in 2024.
I love it. I love it because when you look at Christmas and all the buy now, pay later stuff that became very popular, later's going to come pretty quickly here. So I wonder
Later
about the.
always comes. Later always comes. And the only thing that's holding up that is that we're seeing good, solid wage gains, and that's all good. But the wage gains means higher inflation or steadier inflation because folks can afford to pay higher prices. Eventually, that layer it's not coming down; it's there. It's going to catch up.
Yeah, absolutely. Shaw, you have any questions for me?
Yes,
Oh,
your top three picks 2024. Where would you like to see things explode? Do I mean sectors or stocks or whatever's on your mind for 2024?
okay. Let's go with the stock. We both know IBM. IBM is the original AI, is it not? I mean, Watson beat
This
chess grandmaster, right? And from my perspective, it's a service company. It's not a hardware company, so they don't have to worry about somebody barking, coming at them with new products. All they have to worry about is getting it in front of you and I and in businesses, most importantly. I think IBM is going to be a sleeper of an AI stock. Outside
Okay,
of
I
that,
like it.
yeah, going to, I think if interest rates go lower, as we suspect they will, I think you are going to see a lot of people out there buying houses. I don't think you buy the home builders, though. As you and I talked, I think they're kind of stretched. They've been building inventory. I think you look at Zillow and Redfin and the companies who transact the business, not necessarily build the business there. And I think in terms of a sector, I've got to go with you, my friend. I'm either buying the NASDAQ 100 as a broad sector, or I'm going to focus on the semiconductors. Samsung told us the DRAM demand is going down, but demand for everything AI, which goes down to the chips, is going to remain strong. So I think that's an outside, it's a safe play, let's call it. And there are no safe plays. I got one more to throw at you, and this is kind of a curveball. When you got me thinking when you said something about how, and you're spot on. We always love to export our inflation. That's something that a lot of people don't talk about. What about India in the India fund? Is that going to be a landing place of some of this inflation? Because they're bringing up their infrastructure.
India is moving. India is where China was several years, maybe a decade ago. India is going to come on strong. It's got a tremendous tech sector, and they're going to grow that. They have to. They got the population.
Right.
They have to figure out domestic issues. They got energy issues they have to figure out, and also agriculture. They got issues there, but India's coming on strong. I like India a lot. I think it's going to. I'm not a big EM fan as far as the emerging markets, but when it comes to India, that's the exception.
Yeah, that's. I'm glad we both think alike on that. All right, that's it. This has been great, man. It's always fun talking to you. I owe you dinner now. I'm going to take you to the Tide Tables. I've been telling you about it for a while. Next time
Oh,
I'm
I
down
can't
in the
wait to
area,
go.
yep, we're going to go out. Everybody, I thank Shaw for his time. Obviously, everybody who's watching, I hope you got something out of this. We'll get back together soon, Shaw. I promise. Take another look at what happened after earnings season, perhaps, and, take a look at how these elections are kind of grinding out, because I agree with you. I think that's going to be a big factor, and everybody knows it. So that is it. Thanks again, Shaw, for having the time, I should say, to spend with me. I appreciate your insight. And as always,
Uh,
I'm going to wish everybody the best trading success. Have a great night.
Thanks, everyone. Thank you, CJ, very much. Always a pleasure.
See you later, Shaw.